Hey guys, welcome back to the channel. Today we're going to go over the Apple example from the last video. In the last video we talked about selling puts against Apple. Today we're going to go over the flip side. We're going to sell covered calls against Apple. When you sell puts, you want to think about it as if you were trying to buy a stock. When you sell calls or sell covered calls, think about it as if you were trying to sell or short the stock. It's late September 2020. Apple is trading between 106 107. Let's pretend we're gonna sell a stock against Apple in the November expiration strikes. Right now you could sell the Apple 125 strike for around $2.88, as in around the 25 delta mark. So it's within the parameters similar to the puts where we want to sell between 30 to 60 days out, and also between the 10 and the 30 deltas. That gives us a good enough return on our risk. So if you also want to follow the tasty trade mechanics, if you sell it for $2.88, you would try to buy it back for half of what you sold it for. So that means roughly $1.44. The time frame that you want to try to buy it back in may probably around 20 to 30 days. So right now we're selling something roughly 60 days out. So you want to try to buy it back between 20 and 30 days. So who is this geared towards? I would say this is also for intermediate to advanced traders or investors. Beginners can also take a stab at cover calls as well, but I would suggest to sell it at try to sell covered calls against a lower price stock, depending on your financial means. $100 plus stocks might be a little bit too expensive, but it's up to you. And why would you want to sell covered calls? Well, you want to think about it as you're kind of renting out your stock. So if you already own a stock, you could, it's fine to collect dividends if the stock pays it out, but why not try to also collect extra income on the stock? It doesn't hurt. And in fact, using this example, let's say you were able to consistently sell and collect roughly $1.44 in option premium on Apple. That equates to roughly 13.5% return. If you're only able to do it 10 times a year, for example, let's say you need to take off because you're sick, or you need to take a vacation, I think that's a reasonable return. But if you're more aggressive and you want to try to sell it more often, you want to try to sell it 12 times a year, that gives you around a 16.2%. That's also very good. So when you add it all up, the sell the puts to initiate the trade, and then you're collecting some dividends, and then later on you get to sell covered calls against the position as well, that really adds up. So hope that helps, and I'll see you in the next video. If you could like, subscribe, and let me know in the comments below if you want to go over any specific option strategy or stock that you would like to like me to go over. So thank you. I'll see you in the next one.